debit notes payable for the principal part of the payment. We will debit interest expense for the interest part of the payment, which would be calculated as 6% of the $20,000. In other words, $1,200. And we will credit cash for the combined amount of the principal and the interest that is due on that date. We'll also do a similar problem to that when we do the practice problems. And what you'll see when we do the practice problem is that when we make the second annual payment on a note like that, the amount of interest expense for the second year is going to be less, because in the second year of the loan, there'll be less principal outstanding. Therefore, when we calculate the interest for the second year, there's going to be less interest that will be due. Okay, a major part of this chapter deals with the subject of bonds. So bonds are long-term debts that are issued to multiple lenders, sometimes to members of the public, but more often to institutional investors like pension funds or life insurance companies or mutual funds, something like that. We call those lenders bondholders. And usually the bonds are in increments of $1,000 per bond. The face value of the bond, which is $1,000 usually, is the amount that will be paid back to the bondholders on the maturity date. And there are a number of other terms that can be used that mean the same thing as face value. So you can call it the maturity value, or you can call it the principal amount, or you can call it the par value. The maturity date is the date on which the borrower must pay the principal amount back to the bondholders. Some bonds are for 5 years, or they could be for 10 years, or 20 years, or 30 years, something like that. The stated interest rate is the interest rate that determines the amount of cash interest that the borrower pays and the investor receives each year. And there are a number of other terms that can be used that mean the same thing as the stated rate. It can be called the face rate, or the coupon rate, or the nominal rate. Here's an example. It says a 5-year 9% bond is issued at a face value of $100,000. Now, it's probably $1,000 per bond, but this just means that they issued 100 of these $1,000 bonds on January 1st, 2018, and they'll pay 10 semi-annual interest payments of $4,500. And in fact, interest on most bonds is paid semi-annually. In my lab, you'll have to read each problem to see, do they tell you that the interest will be paid semi-annually, or do they tell you that it will be paid annually? So in this way, the way we calculate the $4,500 of interest is that it's the $100,000 of principal times the 9% interest rate times 6/12. So if we were to look at the cash flow pattern on a timeline, on the date of issuance of the bonds, you have a cash outflow from the issuer, or excuse me, you have a cash inflow to the borrower of $100,000 from the investors. And then every 6 months thereafter, you have a cash outflow of $4,500 to make the interest payments to the investors. And then on the maturity date, which is December 31st, 2022, there are actually two amounts that are paid out, because you pay the last interest payment of $4,500, and you also pay out the $100,000 principal that you're paying back to the investors on the maturity date of the bond issue. Now, bonds can be issued at any price if they're issued at the face value, it's typically $1,000. But sometimes they're issued for more or less than the face value. And likewise, bonds trade after that, after the initial issuance date, they trade in what we call the secondary market. So if one investor wants to sell their bond and another investor wants to buy their bond, and they go through E-Trade or Fidelity to transact, then we call that trading the bond in the secondary market. So regardless of whether it's at the time of the initial issuance of the bond or when it's traded in the secondary market, the price of the bond might be at a discount or it might be at a premium. So we call it a discount if the price is less than the face value. In most cases, that would mean if the price of the bond is less than $1,000. We call it a premium if the price is more than the face value. So in that case, it means usually that the price would be more than $1,000. Now, here's how bond prices are usually quoted. So the Wall Street Journal each day provides prices on some of the more commonly traded bonds. It's more difficult to find prices on bonds than it is shares of stock because individual investors don't hold as many bonds. You can't find bond prices, for example, by going to Yahoo Finance because it's just not of as much interest to individual investors, but you can find them in the Wall Street Journal. And so in this case, if we look in the Wall Street Journal for the company whose ticker symbol is SMT, this says that for their 9% bonds that mature in the year 2021, the closing price of the bonds on this particular day was 79.5. Now, that does not mean that if you wanted to buy this bond on that day, that you would pay a price of $79.50. What it means is that the bond closed that day at a price of 79.5% of its face value. So the face value of the bond is $1,000. So it's trading at 79.5% of $1,000. Therefore, if you wanted to buy the bond, you would pay $795 for it. That's how the price quotes work for bonds. So think of that 79.5 as being a percentage of the face value of the bond. Now, there's another interest rate that comes into play besides the stated rate, and that's the market interest rate. That's the rate that investors demand to earn for loaning their money. Another way of thinking of the market interest rate is that it's the rate that you could earn on competitive bond issues from other companies. If you look at the bond market as a whole, what other bonds tend to be yielding if they're of similar quality and for similar maturity dates. And the price that a bond trades at, particularly in this secondary market, is going to depend on the relationship between the stated rate that's printed on the bond and the market rate of interest at any given point in time. So if a bond's stated rate of interest is 9%, and the market rate of interest at that point in time is 9%, then the issue price of the bond will be the same as its face value, likely $1,000. Likewise, if it's trading in the secondary market, the price that it's trading at will probably be $1,000. Now, if the bond's stated rate of interest is 9% and the market rate of interest is 10%, then the bond is going to be issued at a discounted price, or it will trade in the secondary market at a discounted price. The reason for that is essentially supply and demand. If this bond that we're talking about pays 9% interest, but other competitive bonds are available in the marketplace that pay 10% interest, then this bond is not going to be very attractive to investors. So the price of the bond will be bid down by investors, and they won't buy it unless the price goes down from, say, $1,000 to $900. If they can buy it at $900, then they may feel that it's a reasonably good buy at that price, and they'll be willing to buy it, especially because on the maturity date of the bond, they'll get paid back $1,000, the face value of the bond, so they'll have a capital gain when the bond eventually matures. Now, if the bond's stated rate of interest is 9% and the market rate of interest is 8%, then this particular bond is going to be very attractive to investors, and the price of it is going to be bid up. So investors may be willing to pay $1,100 for this bond, therefore it will be trading at a premium. Now we're going to go over the journal entries. Thank you. And the journal entries for issuance of bonds are going to depend on whether the bond is issued at its face value, or at a discount, or at a premium. And bonds, of course, are a long-term liability. It usually has to be for a maturity of 5 years or longer before you call it a bond. If it's for less than 5 years, you would call it a note instead of calling it a bond. So bonds are generally for something between 5 years and 30 years. Okay, so here Smart Touch Learning has $100,000 of 9% bonds payable that mature in 5 years. The company issues these bonds at face value on January 1st, 2018. So when they're being issued at face value, the journal entry is pretty straightforward. We would debit cash for the cash that they're taking in from investors, $100,000. We would credit bonds payable, $100,000, and that will go on to their balance sheet as a long-term liability. Then the bonds are going to pay interest each June 30th and December 31st. And again, that's pretty typical that they pay interest every 6 months. So to figure out the amount of interest expense on the first interest payment date, we would take the $100,000 times 9% times 6/12. So that's $4,500. So we will debit interest expense $4,500. We will credit cash $4,500. Okay, next we're going to look at the example of where bonds are issued at a discount. So it says Smart Touch Learning issues $100,000 of 9% 5-year bonds that pay interest semi-annually. The market rate of interest is 10%. So you know, because of the relationship between the 9% and the 10%, that those bonds are going to be issued at a discount. And it says Smart Touch Learning actually receives $96,149 and records a discount of $3,851. So we will debit cash for the amount of cash that they actually take in from investors, which will be $96,149. Then they will have another debit to the account that we will call discount on bonds payable. and that's where we're going to record the $3,851. And then the credit to bonds payable will still be for $100,000. We have to credit bonds payable for $100,000 because on the maturity date, the amount that we have to pay back to the investors is still $100,000, no matter what amount of cash it is that we got from the investors up front. Now, if we look at the way the bonds are going to be reported on the balance sheet immediately after this transaction, it's going to say under long-term liabilities, bonds payable $100,000, less discount on bonds payable $3,851, and then what we would call the carrying amount of the bonds, which is the difference here, would be $96,149. So discount on bonds payable is what we've referred to before as a contra account. A contra account is paired with another account that appears immediately before it, and it has the effect of reducing the value of that other account that it is paired with. Now, when we get to an interest payment date and we're dealing with a bond discount, then the recording of the interest expense is going to be a little bit more complicated, because on each interest payment date, we also have to amortize the bond discount. We amortize part of it off on each interest payment date so that by the time the bonds mature, all of the discount will be gone. All of it will be amortized away. So here, we know we'll debit interest expense, but I would not fill in the amount of the debit for interest expense until we figure out what the discount on bonds payable is that we're going to credit. Remember that when we set up the discount on bonds payable, back when we issued the bonds, that was a debit to discount on bonds payable. So now, if we're amortizing away part of that discount, if we're reducing it, that's going to be a credit to discount on bonds payable. And the number of interest payment periods that we have over the life of the bonds is 10, because they told us that they're 5-year bonds. And there's an interest payment period every 6 months. So if they're 5-year bonds, there have to be 10 semi-annual interest payments. Therefore, we take the entire discount that we are working with, $3,851, and we divide it by the 10 interest payment periods to get $385. And that's the amount that we'll be amortizing during this interest payment period. So we credit discount on bonds payable for the $385. Now, the amount of cash that we pay out to the investors is going to be the same regardless of whether we issued the bonds at face value or at a discount or at a premium, because it's always based on the stated rate that is printed on the bond certificate. So the amount of cash that we pay out is still going to be $4,500. Now notice that to record the amount of interest expense that we have here, we add together the amount of cash that we pay out in interest and the discount on the bonds payable. So that makes our interest expense that we record $4,885. Our interest expense is actually more than the amount of cash that we pay out in interest to the bond holders. Now, if two amortization periods go by, two interest payment periods go by, you see here what happens to the T account. What are you doing here? What happens to the T account that's called discount on bonds payable? Now the discount is down to a balance of $3,081. So if we looked at the balance sheet now, a year after we had first issued the bonds, now it's going to say bonds payable $100,000, less discount on bonds payable $3,081, and the carrying value of the bonds will be now up to $96,919. And here's what an amortization schedule would look like for amortizing the discount on the bonds payable. So again, note that we're amortizing it over 10 periods. And so main thing I want you to notice here is that by the time the 5 years are up, when we reach the maturity date for the bond issue, the carrying amount of the bonds is up to $100,000. So then it becomes very easy to record the journal entry to pay back the investors, because on that date there'll be no more discount left. So we'll see later when we retire the bonds, pay back the investors. It'll be a very simple journal entry to do that when there's no more discount left. Okay, now we'll look at the example where the bonds are issued at a premium. So here we'll have an account called premium on bonds payable, but we don't call that a contra account. Instead, we call it an adjunct account. The reason we don't call it a contra account is that a contra account always reduces the value of the account that it's paired with. Well, in this case, the premium account increases the value of the bonds payable account that it's paired with. So it wouldn't be technically correct to call it a contra account. So we call it an adjunct account instead, to reflect the fact that it's related to another account, but it doesn't really reduce the value of the account that it's related to. So here in this example, it says that they issue the 9% 5-year bonds when the market interest rate is 8%. So you know, because the bonds have a higher stated rate of interest than what the market interest rate is, that those bonds are going to be issued at a premium. So it says the bonds are priced at 104.10. So that means even if they didn't tell you the dollar amount that Smart Touch Learning is going to receive, you could tell from that price that if it's $100,000 face value, that the amount of cash they'd be receiving would be $104,100. So for our journal entry, we debit cash $104,100. And then we have two accounts that we credit. So we credit premium on bonds payable, $4,100, and we credit bonds payable, $100,000. So then if we look at the balance sheet, it's going to say bonds payable, $100,000. Add premium on bonds payable, $4,100, and therefore the carrying value of the bonds will be $104,100. Okay, now we get to the first interest payment date after 6 months. So when we first booked the premium in the previous journal entry, we credited premium on bonds payable. So now if we're amortizing away part of the premium, that's going to mean that we want to debit the premium on bonds payable. And again, there are 10 interest payment periods in the 5-year life of the bonds. So we take the total premium of $4,100, and divide it by the 10 periods. And that tells us that it's $410 that we're going to amortize away in each period. So that's why we would debit premium on bonds payable $410. The amount of cash interest that we pay out, which is reflected with a credit here, is still going to be $4,500. So in this case, notice that the interest expense that we record with a debit is less than the amount of cash interest that we're paying out. We take the cash interest of $4,500 minus the premium on bonds payable, $410, to get the interest expense, which is $4,090. Then after a year later, after there have been 2 interest payments, then what's going to appear on the balance sheet will say bonds payable $100,000, add premium on bonds payable $3,280, and the carrying value of the bonds at that point in time will be $103,280. Okay, now when we retire the bonds, in some cases they may be retired early, and in that case it's possible that you'd have a gain or a loss on the retirement of the bonds. But I don't think there are any problems that you're going to have to do in my lab where you have to worry about a gain or loss on retirement. So the main thing I want to focus on here is just where you retire the bonds on the maturity date. So Smart Touch Learning has $100,000 of 9% bonds that mature on December 31st, 2022. Note that all interest has already been paid and the discount is fully amortized. So to retire the bonds, it's very simple. All we have to do then is the reverse of what we did when we first issued the bonds, if it was assuming that we were issuing them at face value. So what we do is we debit bonds payable $100,000 to remove them from our balance sheet. We credit cash $100,000 for the cash that we're paying back to the investors on the maturity date. Okay, there's also a discussion in this chapter about how we report liabilities on the balance sheet. And so here's an example of the liabilities section of a balance sheet. And just a couple things here I want to point out to you. So a lot of things listed here are current liabilities. And we mentioned last week that if you have a long-term liability, but some of the principal payments on it are due within 12 months, then those principal payments have to be treated as current liabilities. So notice here there's a line item that says current portion of mortgage payable. So those would be the next 12 monthly mortgage payments, and only the principal part of the mortgage payments, not the interest part of them. That's reflected there. And then there's a line item that says current portion of long-term notes payable. So the next 12 months worth of principal payments on the notes payable are shown there. Then under long-term liabilities, where it says mortgage payable and notes payable, it means those numbers are net of those first 12 months of payments. So it would only be including down there the payments that occur more than 12 months out in time. And then under long-term liabilities, you see where they have bonds payable. Underneath bonds payable, it says less discount on bonds payable, and it shows a net amount, which is what we're referring to as the carrying value of the bonds payable. Okay, there's one financial ratio at the end of this chapter. This is the debt to equity ratio. And I think back around chapter 2, we had what's called the debt ratio. Well, this is very closely related to the debt ratio. This ratio tells us basically whether the company is financing its assets more with debt or with equity. So if the ratio is greater than 1, they're financing their assets more with debt than with equity. If it's less than 1, they're using more equity than debt to finance their assets. So here's some data from Kohl's Corporation, and computing their ratio for the more recent year here, it's 1.48. So they have more debt in their capital structure than they do equity. If you knew what the debt ratio was, which is liabilities divided by assets, you could figure out what the debt to equity ratio is. Likewise, if you knew what the debt to equity ratio was, you could figure out what the debt ratio was. So the two ratios are very closely related. You really don't need to know both of them to get enough information about the company's debt. They're just really two different ways of looking at the same information about how leveraged the company really is. Okay. So that was a fairly short lecture, but the problems in this chapter can be kind of tricky when we particularly talking about the discounts and the premiums on bonds. So there's some problems that I definitely want to go through together that deal with that. First problem here is just one on notes payable. So for the first journal entry, it says they purchased equipment costing $80,000 by issuing a 5-year 8% note payable. So we know that so they're not getting cash, instead they're getting equipment. So we know the debit would be to equipment for $80,000. And then the credit would be to notes payable, $80,000. And at the bottom, purchased equipment by issuing a note. Okay, then we get to the on December 31st, we want to accrue interest on the note. So it looks like at that point in time, the note's been outstanding for 3 months. So we know when we accrue interest that we're going to debit interest expense, we're going to credit interest payable. And was it 8%? So if I split my screen here, so $80,000 times 8% times 3/12 for the 3 months. 3/12. So it should be $1,600 that we accrue. And at the bottom, put recognized accrued interest. Okay, then paid the first installment on the note. So that means that there'll be 9 more months of interest for January through September, basically through October 1st. So for interest expense for 9 more months, that would be 3 times as much as we accrued in the last journal entry. So 3 times 1,600 would be $4,800 of interest expense. And then we'll reverse the accrual that we made back on December 31st. So we'll debit interest payable for $1,600. And we will debit notes payable. The problem said that the annual principal payment is $16,000. And then we credit cash for the combined total of those 3 debits. So that would be $22,400. And at the bottom, paid first installment of note. Okay, then we accrue interest on the note again on December 31st, 2025. Now we don't have as much outstanding anymore. So split my screen here again. So it was originally an $80,000 note, but we paid off $16,000 of the principal. So now I guess that means we have $64,000 of the note left. So we take that amount times 8% times 3/12. So this time to accrue the interest, it's going to be $1,280. So debit interest expense, $1,280. Credit interest payable, $1,280. And at the bottom, recognize accrued interest. And then it says, considering the given transactions only, what are Cala Video Productions' total liabilities on December 31st, 2025? This is a little bit tricky. So we said what's left of the note is $64,000. It was $80,000, but we paid off $16,000. And then the piece that you might forget is that we now have interest payable of $1,280. So we have to add, that's a current liability, but still a liability. So we have to add that $1,280. So that would be total liabilities of $65,280. Okay, next problem deals with bonds. So first of all, we're going to issue the bonds at their face value. So we'll take in cash, and the problem tells us that the issue is for $70,000. And we credit bonds payable. So that should be all there is to that. And then journalize the payment of semi-annual interest when the bonds are issued at face value. So split my screen. So $70,000 times 9%. Times 6/12. So $3,150. So we're going to debit interest expense $3,150. We're going to credit cash $3,150. Okay, now we're going to assume that the bonds are issued at a price of 92. So notice they don't tell you what the dollar amount is that they take in or what the dollar amount is of the discount. So we have to compute that. So the first thing we would do is take $70,000 times 92%. So that's $64,400. So that's how much cash they'll take in. So we'll debit cash, $64,400. And then the discount on bonds payable will also be debited. So that will be for the difference between $70,000 and $64,400. So that's $5,600. And then we'll credit bonds payable, and that's always going to be based on the face value of the bonds. So that's going to be for $70,000. Now we're supposed to journalize the payment of the semi-annual interest. So we'll debit interest expense, and then I won't fill in the dollar amount for that yet until we do the rest of the journal entry. So there are two accounts that we're going to want to credit. One will be for discount on bonds payable, the other one will be for cash. And then cash is going to be the same as it was in the first part of the problem, because regardless of whether the bonds are issued for face value or discount or premium, the cash interest payment's always the same. So for cash, we can fill in $3,150. Okay, so now to amortize the discount, the total discount was $5,600, and the bonds are 10-year bonds. So there are 26-month periods in a period of 10 years. So we divide 5,600. Is that 50? Yeah, 5,600 by 20 6-month periods. And so for each period, we're going to want to amortize $280 of the discount. So that's another credit. So we'll fill that in. And then we know now what the amount of interest expense is that we're going to debit, because we would add together our two credits. So adding those credits together, we come up with $3,430 that we will debit to interest expense. Okay, next we're going to assume that we issue the bonds at a price of 103. So in this case, we would take the $70,000 times 103%. So that would be $72,100. So we'll debit cash, $72,100. And then there'll be two accounts that we credit. So one of them will be premium on bonds payable, so that's gonna be, $2,100. And the other one will be bonds payable, and that's gonna be the $70,000. Okay, then, journalizing the semi-annual interest. We'll debit interest expense, but we'll leave that dollar amount blank for right now. And then, we will debit premium on bonds payable. We initially recorded the premium by crediting it, so to amortize part of it off, we're going to debit it. And so the total premium is $2,100. And so we divide that by 20 6-month payment periods. And so that's gonna be $105 that we amortize in each payment period. So we can fill in there a debit of $105 for the premium on bonds payable. And then for the cash that we pay out in interest, that's a credit. And just like in the other parts of the problem, that's still going to be $3,150 because that's based on the stated interest rate on the bonds. And so now to compute the amount of interest expense, it's the $3,150 minus the $105. So that would be interest expense of $3,045. Okay, then it says, which bond price results in the most interest expense for Anderson? Which one was that?
Discount price?
Yeah, it was the discount price of 92. The reason for that, the discount must be amortized over the life of the bond, resulting in interest expense that is greater than the amount of interest actually paid in cash. Okay, then I have some multiple choice problems here. Some of these can be tricky too. So this company borrowed $84,000 on a 7% 10-year note with annual installment payments of $8,400 plus interest due on December 1st of each succeeding year. On December 1st, the principal amount was recorded as a long-term note payable. What amount of the note payable will be shown as current portion of long-term note payable on the balance sheet as of December 31st, 2024? Somebody help me with the answer to this?
It's 8,400 to the question.
Yeah, right. Maybe self-evident, but yeah. $8,400 is due within the first year, so that's going to be shown as the current portion of the long-term note payable. Okay, Garden Products borrowed $82,000 on 11% 16-year note with annual installment payments of $5,125 plus interest due on December 1st of each subsequent year. Which of the following describes the first installment payment made on December 1st, 2025? Well, the interest part,
On your, go ahead.
I'll calculate it. 82,000 times 11%.
What's the interest?
So, I guess it'd be B, $5,125 principal plus $9,020 interest. Okay, Brussels company purchased equipment and signed a 6-year mortgage note for $93,000 at 15%. The note will be paid in equal annual installments of $24,574 beginning January 1st, 2025. On that date, the journal entry to record the first installment payment will include, now notice that's the total payment, not the principal part of it, but the total payment will be that dollar amount. So, they're going to credit cash, but it won't be for $10,000. It's going to be credit cash for $24,000. So, and it's not going to be the debit mortgage payable for $24,000 because only part of it is going to be mortgage payable. Part of it's going to be interest expense. So, the only thing that we don't have to calculate it really. The only thing that would make sense here would be the last one, debit interest expense for $13,950, because we know of that payment of $24,574, part of it's going to be debited to mortgage payable and part of it's going to be debited to interest expense. So that's the only answer here that would seem to make sense to me. Okay, this company purchased equipment and signed a 6-year mortgage note for $80,000 at 15%. There'll be equal annual installments of $21,139. Calculate the balance of mortgage payable after the payment of the first installment. So this one's a little tricky. So the first thing I would want to do is figure out how much of the first payment's going to be for interest. So 80,000 times 15%, it's $12,000. So the part of the first payment that is for principal would be $21,139 minus the $12,000. So that's $9,139. So that means that the amount of the mortgage payable after the first payment is going to be $80,000 minus that $9,139 of principal that we just paid off. So that would leave us with a principal balance of $70,861. Okay, the interest rate that investors demand to earn for loaning their money is known as the what?
Market interest rate?
Yes, good, market interest rate. Okay, this company issued 309,000 of 5-year bonds at a stated rate of 14%. Bonds were issued at par. They make semi-annual payments on April 30th and October 31st. On December 31st, they made an adjusting entry to accrue interest expense at year end. No further entries were made until April 30th. When the first payment was made. What amount of interest expense was recorded for the period of January 1st to April 30th? Okay, so and they're issued at par, so that makes it easier. So I would take $309,000 times 14%. Times 4/12 for January through April. That would be $14,420. Okay, this company issued $30,000 in bonds payable for $23,300. They're 8-year bonds with a stated interest rate of 11%, pay semi-annual interest. They use the straight line method to amortize the bond discount. This reminds me of something I should have said before. There's another method that can be used for amortization called the effective interest method. And GAAP accounting actually says that you should use the effective interest method unless the results for the straight line method are not significantly different. Well, the effective interest method is a lot more complicated, and that's covered in the appendix to the chapter, but we're not going to study the effective interest method. So don't worry about the appendix to the chapter at all. Just focus on the straight line method of amortization. That's enough to have to worry about. So just do straight line amortization. Okay, the question here says, after the second interest payment, what is the bond carrying amount? So first of all, we better figure out what the discount is that we're amortizing. So $30,000 is the face value of the bonds, and then subtract from that the issue price of $23,300. So the total discount is $6,700, and so 8-year bonds, they pay interest twice a year. So if we take that $6,700 divided by 16, each interest payment date, there'll be about $419 that we amortize away. So the carrying amount on December 31st, 2024, that after 2 payment dates, what we'll do is we'll say it'll be the price they are issued what they are issued at, $23,300, and then we'll add back 2 amounts that we amortized. So add back $419 for the first amortization and discount, and then add back another $419 for the second time that we amortize the discount. So it should be $24,138 as the carrying value of the bonds after 2 interest payment periods. Okay, this company issued $17,000 in bonds for $24,800. So that would be a premium. They're 8-year bonds with a stated interest rate of 11% that pay semi-annual interest. They use a straight line method. After the first interest payment date, what is the bond carrying amount? So the premium would be the $24,800 minus the 17,000. So at 7,800, so then we take that 7,800 premium divided by 1,600, or 16, I'm sorry, 16 interest payment periods. So that's $487 about, and so then we will subtract the amortization of the premium from the $24,300 $24,800. We only have to subtract one period's worth of amortization for this problem. So it's going to be carrying value of about 24,312. Okay, here's some T accounts for a company. Bonds payable has a credit balance of 69,000. Premium on bonds payable has a credit balance of 4,000. Now I said that I didn't think you were going to have to do any retirement problems where there was a gain or loss, but I guess I was wrong about that. There aren't any homework problems with that, but here's a multiple choice problem that you could get that has that. So what you do if there's a gain or loss on retirement, you compare what the carrying value is at the time of the retirement to what you have to actually pay out in cash to retire the bonds. So here you can see that the carrying value of the bonds is the 69,000 plus the 4,000 premium. So the carrying value is 73,000. They actually pay to retire them 69,150. So if they don't have to pay as much to retire them as what they're shown on the balance sheet at, that results in a gain. And so the gain is going to be the difference between those two figures. It's not too much different than having a gain when you retire plant assets that we studied in chapter 9. So the gain should be gain on retirement of $3,850. Okay, and here there are a bunch of different liability accounts, and the question says that what's the total amount of current liabilities? So we'll start with accounts payable, 15,000. Most of these are current liabilities, but not all of them. And then employee health insurance payable, 750. Employee income tax payable, 1,100. Estimated warranty payable, 1,100. And then, what's it say? Long-term notes payable, that would not be a current liability. Then FICA payable, that would be, so that's 1,160. Sales tax payable, that would be 670. Mortgage payable would not be, bonds payable would not be. Current portion of long-term notes payable, that would be a current liability, so that's 8,500. And that's everything. So if I sum that, I get $28,280 for the current liabilities. Okay, that was the last problem.